Charlie Munger said that if you know where you're going to die, you're not going to go there. Which relates to our Invest With Me video today, which is the real reason why beginner investors or investors quit investing. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. In today's video, we're gonna talk about this topic, and we're also gonna invest at the same time. So, first off, let's check out the markets. Right now, Dow Jones is down by 1.72%. The S&P 500 is down by 2.06%. And the Nasdaq is down by 2.39%. So how does it make our portfolio look like? So right now, our portfolio, or my portfolio, is down by 2.36%. For the month, it's actually down 0.26%. And year to date, it's down 1.41%. But if we look at the 1 year or the past 12 months, we can see that I'm still up by 13.97%. And if we look at the past 3 years, I'm still up by 54.49%, which is really great to look at. And since we are down by 2.36%, we're going to invest a little bit more today so that we could have that small incremental shares that we could access from lower prices. We get to buy more shares with a little amount of money. Today we're gonna invest $150 to the portfolio. Today for industrials, we're going to invest $24. For financials, we're going to invest, it shows here that we're going to invest $10.05. For communication services, we're going to invest $37.05. And then for technology, we're going to invest $19. We're not really gonna, we don't follow it 100% because we have like our own preference. This is just this is just a guide. Okay. So starting with our industrials, it says here that we're going to invest $24, which is our Uber, which is the company, one of the companies that we're growing our position. Uber, it says here $24. We're going to invest. Click Uber, and then we are going to buy. It says $24. I want to buy like $20 of Uber. $20. Okay. And then on the market order, it shows market because, we don't really need to. It makes it so that it gets filled faster. Okay. Preview and then buy Uber. Okay. Just happened. Just that. We got 2.39 shares of Uber. Next, we have financial services. These companies are Visa and MasterCard and Berkshire Hathaway. Starting with Visa, it says here we're going to invest $10.05. Starting with Visa, there you go. Buy. Let's put $10.05. $10.05. Okay. We bought 0.032 shares of Visa. Next is MasterCard. Currently, we are actually down in MasterCard. We are down $64, which is not so bad. That means that if we buy more shares today, it will pull down our cost basis, which in the future, once it's go higher, we're going to have a better gains for it. Okay. Oops, we got to put dollar amount. Since we're trying to increase the positions in MasterCard, I'm actually planning to add $15 for MasterCard. $15. Okay. And $15 of MasterCards gave us 0.028 shares. Next, so we're going to skip Berkshire Hathaway like what we did last time. We're going to move on to our next sector, which is communication services. It says here that we're going to invest $37.5. But before that, I would like to talk about one of the reason why one of the real reason why new investors and beginner investors quit investing. So at first it feels exciting when you buy your first stock, when you build your portfolio. You check the prices every day and there's a lot of movement and it feels really big. Like the dopamine hit every time you buy something, it's always in there. First few months. And then things start to slow down. The whole year round, it only shows a little bit of high, a little bit of low, and then when you look at it on a zoom out perspective, it just shows a flat line for some of the companies. And if this happens to new investors or beginner investors, it makes them they start to think that nothing is happening, no drama, no rush, no exciting thing that's happening. They stop caring. Okay, beginner investors, they look for that high, for that movement, for that action that they see with other people's portfolio. So they start thinking that nothing is happening, so you stop adding, you stop paying attention to the market. Worst thing that you can do is to liquidate your investment. And then when you liquidate your investment, something's gonna happen. Like right before that, the growth shows up. I'm guilty of this. Like it happened to me. Like it's just going down. One of my investments just going down. To be exact, it is when one of my investment from before, it was Meta. It's just going down. It's just going down. Nothing's happening. Always bad news. So I just liquidated it. I found something shiny. I got bored on. I didn't. There's no action that's happening. There's no going up, or there's nothing. So I thought to myself, oh, maybe just liquidate this. What happened was after I liquidated it, suddenly Meta went up from $200 to $600, and it's really a bummer for me because I've been holding it for a long time. I lost a lot of money, but it's okay now. I moved on. So boring does not mean that your investment is broken. It just means that your money is working quietly. It means that there are things that you just have to be patient. You just gotta wait. You don't need to look for the action or the dopamine that gives you that excitement. So real investing looks simple. You add, you wait, and then you repeat those process. You just add and then you wait. I mean, of course, you gotta learn to when to sell or when to let go, but that's a different kind of story. We're just trying to build here the foundation that a long-term investor or a new investor should understand. Okay, let's keep investing because it's 10:42 right now, and market is gonna close soon, and we want to buy those low price stocks. So next on our list is communication services, which is Google. So it says here that we're going to invest $37.05. Right now we are going to invest, I'm thinking invest like $38 flat. Let's do $38. $38. But okay. $38, and that is 0.118 shares. So now we're gonna go invest on our technology, starting with Apple, which is really down right now. Right now, Apple is down by 4.39%. Okay. We go to Apple, buy. Says here we're gonna invest $19, but I'm not really trying to. I'm just, constantly adding to Apple, but I'm not trying to build the position. So I'm thinking adding $10 to Apple. $10 to Apple. And that is 0.04 shares of Apple. I'm constantly increasing the amount of shares that I have for each companies. And, at some point I reached 89.584 shares of Apple just doing this. Okay, next is we still have 3 companies that's remaining. That's Amazon, Berkshire Hathaway, and Microsoft. Next on our list is Microsoft. We're also going to just, add a little bit of Microsoft because we're just constantly increasing it. I'm not trying to build my position in it, but it's a bit higher in my hierarchy of things. So I'm going to put $15 in Microsoft. There you go. And it's 0.032%. Oh, no. 0.032 shares of Microsoft. Now, we have those unrealistic expectations that we see from social media. That's one of the things that I would say really culprit to like most new investors that they watch this, they follow this social media creator, they follow this social media influencer, and they would see like all those shiny stuff that's happening on their portfolio. And this kind of expectations push the new investors or beginner investors, their expectations is being pushed really high, and they see that this influencer is beating the stock market by this amount of margin, and thinks that, oh, if she can do it, I could do it too. Which I would say it's easy, making the expectations really high and unrealistic. So if we kind of like pull it down a little bit, or bring it to reality a little bit, if an influencer can beat the S&P 500, they wouldn't actually be doing, social media like this. They would focus more on their social media, or they would focus more on their investment activities because they make more money from that. Yes, granted that there are some exceptions. A lot of people would show that they beat the S&P 500 on a consistent basis, but you don't really see the full story of the portfolio. So if anybody can beat the S&P 500 year over year and on a consistent basis, they would just focus on that, and they will not be on YouTube, and they will not be on the social media. So let's ground that expectations and make it so that it's close to reality. The S&P 500 is the standards of the markets. So the return, if you could match or at least be on the same side of the S&P 500, which returns between 7% to 10% year over year, you're actually winning. In fact, if you just put your money in the S&P 500 ETFs like VOO, you would be following the return of the S&P 500, like on a consistent basis. And that's what I did. I have on two of my accounts or my retirement accounts, I only have like the S&P 500. And right now, looking at those accounts, one of my account is down by 2.09%, and the S&P 500 is down by 2.10%. Okay, going back to investing in our portfolio, our next company that we're going to invest at is Berkshire Hathaway. So $42.70, we are going to invest $17 to Berkshire Hathaway. $17. Let's put a 20 cents in there too. That is 0.035 shares of Berkshire Hathaway. How much do we still have on our investment balance budget? All right, we're gonna go invest in Amazon. We still have $25.69 that we could use. So we put everything in there because we're building our position in Amazon. Okay, buy Amazon. And that is 0.111 shares of Amazon, which is a really nice number. Okay. All right, that's $150 added to our portfolio, which bought a lot more stocks than usual because the market is down. And that will push our portfolio higher once the market bounce back or once this recent events like fade away. It will also increase the dividends that we're going to receive from our dividend paying stocks, which is really nice. I started as a dividend investor, so I appreciate that kind of return, that kind of consistent dividends that's coming in. And that consistent dividends that's coming in, it's slowly increase our portfolio, and that growth is actually normal. That kind of growth is actually normal. It takes time. It's not slow. It just takes time. We're not here for the fast wins. We're not trying to chase the fastest winners. We're here to grow our investments. And real progress is repeatable and consistent small wins. If you get value in this video, don't forget to subscribe and like this video. It's free and it will definitely help my channel. Let me know in the comments, what do you think about this topic today? Can you add something that, reasons that you experienced that you almost or you did liquidate your investment or quit investing? It'll be a really helpful insight to the community. So, with that, have a great day. Keep investing and peace.